talking trust losses here, trust tax losses, and I'll go through with you how a trust holds a tax loss for a property and then for business. So for property, if you're going to have a property, an owned property in a trust that is going to make a loss, in other words, the rent revenue from the property's tenant is less than the interest on the loan and the repairs and maintenance rates, etc. from that property. If the expenses are more than the rent, you've got a negatively geared property in a trust name. If that's the case, the trust has a loss on its tax return and it cannot offset that loss against anything else. In a personal name, that loss can be offset against other income in the person's name. So why would you have a property in a trust that creates a loss? And there's one reason only, and it is if you have another profitable business in a trading trust sitting alongside the other trust which has got the property in it. So what happens with our clients is they're running a business in a trading trust. They have excess profit within that trading trust and they have to distribute that profit at the end of the year, so they pay taxes on it. And what they do first is they send profit from the trading trust into this investment trust which holds the property with the tax loss, and they can offset the income of the trading profit coming across into the investment trust against the rental loss. So that is why you would put a property in a trust name and have it negatively geared or with a tax loss. And we advise it commonly here at Paris Financial because, of course, a separate trust for investments next to a trading trust which is running the business means that all of your business risk is in the trading trust and you're developing investments which are fully protected in this investment trust. So that's a really important one. In business, of course, you could also have a loss in business in a trust. However, enormous amount of change and controversy about these trust losses going back years and years. So it's worth telling you just about a little story. In the late 80s, I was actually an adult. So a bit sad, but I was an adult in the late 80s. And we had a client at Paris Financial who was a very wealthy client. Now in the late 80s, there was a recession here in Australia. A lot of people lost a lot of money through that recession in the late 80s and early 90s. Our client was very profitable and had a fair bit of dough. And what did they do? Very, very smart and legal at the time. They took a heap of their dough and they bought tax losses in structures that other people had lost. So you had people who went down, they had trust losses in their name. Our client went and actually bought those trust losses because, of course, they were hugely valuable for tax. That was the late 80s. That guy saved a lot of dough. You get to the early 90s and the tax office jumped on this and it couldn't happen again. And the way they did it was that you need to be in the same business or the same ownership to claim these trust losses. Okay, so that wealthy fella of ours who went over and bought tax losses was going to a completely different business and a completely different owner. The tax office knocked it on the head, and good on them, and you can't do it again. So, back to today, a loss in a trust. So we have plenty of clients who start off a business in a trading trust and it is growing. However, in the first 2 to 3 years, they are going to create a loss, meaning the income is going to be, say, $100,000 and they've spent $150,000 in paying themselves, getting the business up and going, getting all their marketing, those sorts of things. So in that instance, where they've got $150,000 in expenses and $100,000 in revenue, in their trading business, that $50,000 loss carries forward to the next year, and when they become profitable, that loss is offset against those profits in future years because they've got the same ownership structure. Tax losses within trust can be extremely valuable too as they flow through families. So sometimes we'll have clients where the family's lost a fair bit of money through their business in a trust, but being the same ownership structure, someone else within that tight-knit family can start a business and can offset that loss. They're really important to know how they work. Tax losses in trusts. See ya.